Captains of Industry, brought to you by Airtel.
Hello and the warmest welcome to this edition of Captains of Industry. Now, Redefine released their results this week. A fairly good showing, but investors weren't really convinced with the share price down on the day. Nonetheless, the company is excited about property and has grown their portfolio of property assets in countries like South Africa, Europe and Australia. But the never-ending debt issues in Europe have made investors wary. They're also changing conditions here in South Africa as well. So investors are starting to wonder if Redefine is exposed and whether they'll continue on their winning streak. Joining us now to discuss whether property remains king is our Captain of Industry tonight, Marc Wainer, co-founder and CEO of Redefine. Marc, thanks so much for coming through. As we said, results season coming out. Yields not as great as what we've seen in the past, and investors are just wondering whether or not, this is still the property stock to be investing in.
Look, I think it's one of the property stocks to be invested in, and clearly we've come out of a background 3 or 4 years ago where growth in the sector was 13, 14, 15% per annum, and now it's 3, 5, 6%, much more pedestrian, much tougher times. We told the market last year that this year would be our trough year for a whole lot of reasons following the merger. We've then embarked on a new strategy, so the market's somewhat confused, but we believe we're doing the right thing at the right time for our investors. Given the turmoil in world markets, we have to have a much more defensive position. Property is long-term, not half year by half year. So what we're looking for is a portfolio which will give increases in distributions, but also long-term capital growth.
I think the buzzword right now is consolidation. We're seeing you scaling back, selling off some of your assets, trying to just have a smaller, more manageable portfolio. Why are you doing that?
Well, it's not really so much a question of scale. What happened post the merger? We merged Apex High, Redefine, and internalized our management in Redefine. That gave us a portfolio of in excess of 400 properties, many of which were small, 5 to 10, 15 million, and it was always our strategy to clean up that portfolio. We managed to do that in a big bang, sold 98 properties to Arrowhead, and have unbundled the units, or will be unbundling the units that we get to our shareholders, which we had two choices. Redefine could have left itself owning the units, which would have been more beneficial to Redefine, but we thought long term it's a better choice for our investors because we believe that fund is going to grow and that there is a place in the market for a fund which has high yielding assets. But because we're not going to be buying any more of that kind of assets, it was 6.5 or 7% of our income. So let's give it to somebody who can do something with it.
We talk about changing market conditions, and there are specifics and peculiarities to South Africa, and then there's the global one. Before we look internationally, in South Africa, what are the challenges? Because we are seeing that quite a few problems with the tendering of government properties, with government being a tenant, utility costs rising, inflationary pressures setting in. How do you cope in an environment like that?
We're not, to be perfectly honest. We have a large exposure to government properties. And we cope with the fact that we get short-term leases actually works for us and against government, because had they entered into long-term leases, they would have been paying much lower rentals. But on the utility and rate side, government don't pay increases in rates. So whatever increases we've seen in rental has been nullified. So if you looked at our results this year, we broke up our expenses in a per 100 rand. What are our expenses? And our rates, for example, have gone from 3 rand 10 cents to 4 rand 10 cents. That's a substantial increase. Our power has gone from 1 rand to 1 rand 40. And you can only pass on so much to the tenants, and then it's the straw that breaks the camel's back. So that's had an impact for us of over 40 million rand, just those two items. So it's significant. What are we doing about it? There's very little we can do about rates other than, and I'll come back to that, but in terms of power, we've now employed full-time an electrical engineer. We get people coming to us with every kind of gimmick and product that they say can save electricity. Unfortunately, I or none of our executives are really in a position to judge. So we need an expert to do this, and it's a big, big focus of ours to try and reduce the cost of power. What we do find, as you say, the whole tendering process at government is flawed, and it's sad in terms of we've all heard about the police lease and all the rest of it. But clearly there are many instances where government, for whatever reason, and let's just call them dubious business practices, where they're paying rentals of 60, 70% above market.
Do you think things are going to improve in the horizon now that obviously the media is exposing some of those infractions within government, with the market conditions persisting? I mean, in general, there's been a bit of a property slump, prices down, vacancies low, rentals not yielding substantial earnings. There is a sense that, whereas we used to think that property was king, it isn't so anymore.
Look, property is a basis of creating wealth over a period of time. You can't judge it in terms of troughs and peaks and valleys. So we think, yes, property still is a store of value. I've lived through 7 or 8 of these ups and downs in my career, and it will come back. As somebody once said to me, God doesn't make any more land. There is what there is. But coming back to government and local authorities, what has happened to us, particularly in a number of the smaller local authorities, in some of the bigger ones where we really see total inefficiencies. The property sector is seen as a milking cow, and rates and services costs go up astronomically with a deterioration in value. So if you go back to the view that we can get a very nice initial yield by investing in somewhere in the Eastern Cape, for example, we have to say, what is the likely value of that property at exit 10 years or 15 years down the line? In many instances, we see that declining, okay, or growing at a very low rate.
Okay.
So we're exiting. We've said, as part of our policy and strategy, we are no longer prepared to put up with deterioration of services. We're voting with our checkbook, and we're exiting. We're not going to spend maintenance, we'll do, but we're not going to spend any further money on capital or new developments in those areas. And it's sad because I personally am totally committed to South Africa. I love this country. I had kids who were living overseas. I've made them come back. I've bribed them. I've done whatever I had to do to get them back because I wanted.
It's an easy bribe. It's
kids.
a beautiful country.
It's the most beautiful place. It's a wonderful place to live. It's a land of opportunity, and we really believe we can make a difference.
Right. Your views internationally, because obviously we do know what's happened to property. We do know how the sovereign debt issues in both the United States and Europe are linked so much to badly managed mortgage-backed securities. Your perspective on what's going on there, because you do have a portfolio of assets in the UK, in Germany as well.
We have a portfolio in the UK, Germany, and an interest in Australia. We see, as a result of this, you can look at, is the glass half full or the glass half empty? So our people in Australia and in the UK are taking advantage of the situation and acquiring properties that are coming out of banks or distressed at good value. So we had a meeting yesterday with our people from Australia who are in South Africa for a capital raise, which was very successful. And they're buying a property in Brisbane, government lease, 15 years, okay? 4% per annum escalation, initial yield 8.5%, and you borrow money at 6.5%. Now, if you compare that to South Africa, first of all, we don't have such a thing as a 15-year lease, but let's assume it was 10%. That would be 7.75 or 8%, and money at 9%. So where would I rather buy property?
So tell us the lessons of Australia, because what's fascinating is this is the one developed economy that weathered the storm of the global financial crisis. Obviously, a lot of that has to do with proximity to Asia, trading with Asia. But what is it about Australia that works?
First of all, the regulations. I mean, I couldn't live in Australia. It would drive me nuts because everything is prescribed.
Perfect.
And how you. But what you do know is if you start a process, if you've got to go from A to S or A to P or whatever the number is, if you do it step by step by step, you are going to get your plans approved and it's going to happen. Okay. Whereas here, it's potluck. We learn a lot. I think that they're a little bit anal in the way they do things, but it works. It does work. And what's interesting is the opportunities for offshore. If you look at the Australian property market, our listed property market, 40% is owned by offshore, people out of the States, Asia, and now South Africa. And it's very hard to raise money for smaller property companies in Australia. The large funds will invest in the top 5 or 6, and there's no appetite for the smaller funds. So and the offshore people, the investors from the US and elsewhere and ourselves, are seeing the opportunity. We're putting money in, and it's wonderful because they need us.
Across the ocean, the United Kingdom, and you've been quoted as saying that great prospects in London, not in the UK in general, but in London. Why is that?
In London is its own city. It's got nothing to do with the UK. If anybody visits London and walks down Oxford Street or Regent Street, you don't know anything about a recession or anything else. I mean, it's quite amazing. We can talk about offices and all the rest of it. We last year invested in a hotel portfolio. These are small Holiday Inn Express, and they're bed factories. And we had the report because we had the guys here for the results. Our average occupancy for the year was just over 90%. We are way ahead of budget. And now the coming year, you've got the Olympics, you've got the Paralympics. And London, first of all, their planning is such that you can't have what happened in South Africa. You can't get 5,000 hotel rooms coming onto the market in a year. It takes years and years and years to get planning consent. So it comes on stream very, very gradually. But now if you compare London to Scotland or Wales, it's a different city. It's a different country. London is unique. Everybody wants to own a property in London, wants to be in London. It's just amazing how different it is. And in fact, in the hotel industry, the statistics are shown differently for London and to the rest of the UK.
Okay, I believe in London. I was at school there. Let's talk about Germany, because we know that right now everything is just crashing all around them. They're the ones who need to keep this Eurozone together. And somehow you're also vulnerable there. Do you think you're going to...
Far from vulnerable.
Okay.
When we went into Germany specifically, we decided we would buy smaller properties, so they 10 to 15 million euros. They are typically your suburban small shopping centres, anchored by, in the South African context, let's say a Pick n Pay or a Checkers, a Dis-Chem, the discounters, and discount clothing, your Mr. Price. But these are tenants whose turnovers are 50 billion euros plus a year, employ hundreds of thousands of people, and they take 15-year leases on properties and account for 80% of the income. So in Germany, you can go and buy that kind of property for 8%. They've got costs that relate to it, so maybe you get 7 3/4, but your 5-year money is 3.5%. So your initial cash-on-cash return is in double digits. And then it's indexed to inflation, and inflation is kicking up. The same thing applies in the UK, where we have our office properties are indexed to inflation, and who would have ever thought that we would sit and say inflation in South Africa is 6% and in the UK it's 5%.
All right, enough of the property speak. After the break, we want to find out what makes Marc Wainer tick. He's frank, he's candid. Fun interview. We continue chatting with him after the break.